What's going on, everybody? This is going to be the Q&A for the Becoming an Apex Trader DBT method on market structure. So a quick recap on what we covered in that video. We talked a lot about market structure, obviously higher highs, higher lows, lower lows. We talked about the difference of like who's in control of the market. Is it bullish aggressive, bullish responsive? Is it bearish aggressive, bearish responsive? Is it neutral? Types of trades that we can take during those days, rollovers, sweeps, whether that be rollover tops or rollover bottoms. We also talked about like advanced structure using volume profile techniques, kind of like incomplete auctions or failures to rotate, and how those determine what the market structure is doing. Is it following the same structure or is it shifting into a new structure? A big topic that we had on the video, the market structure video, was talking a lot about the vertical distributions and downward accumulations. I get a lot of questions on those throughout the live streams, but I thought I'd quickly go over what those look like and kind of how you can trade them and things to kind of avoid. We kind of had one today, so it's actually a good day to show this. So for today at the open, we opened up pretty strong. This was the open right here. Pretty much right out of the gate, we were shooting up and we were above the 80 EMA, we were above the 24 EMA. And for that first little bit of price action from like 930 to I'd say around like 953, this little section right here, it's kind of showing you signs that a vertical distribution is starting, but you don't really know for sure just yet. Where you really started to think like, okay, this might be a responsive day, this might be a bullish responsive day, was right around here. Because like I talk about in that market structure video, we want to be looking for the clusters of candles, right? So like the first cluster would be like what's going on right here, very aggressive to the buy side. The second cluster would be like what's going on right here, trying to be aggressive to the buy side, but not really making it too far from that prior cluster, from that prior high. So yes, we are technically putting in a higher high, but it's not really going too far. It's kind of a weak high, right? And then this cluster right here is the first cluster on the sell side that looks decently aggressive. It looks like they were kind of strong as they were pushing down. But the responsive buyers came in, kind of protecting all these candle lows back here, right? They were protecting that 24 EMA, the orange line on my chart. And I talk a lot about this in the new video, the indicator video, that you guys will see after this one. But I talk about like when you have an average and you have two forms of traps. You have a cupping trap or you have a more aggressive kind of a V-shaped trap. And this is more of a cupping trap where it kind of has that cup pattern where it breaks the EMA and then it kind of pulls back and reclaims it. And once it reclaims it, it goes back into more of a responsive vertical distribution. So like I said, you can compare these candle clusters together and we can see that it is putting in higher highs and higher lows. So yes, we are uptrending, but I wouldn't say it's very aggressive until you get to about here, right? That's more aggressive because we are actually staying above that 80 EMA pretty consistently. And if we measure kind of how strong the momentum is breaking these prior highs, it's actually pretty strong. You're actually staying above those prior highs. So you can see like this prior high right here, we break above it, it retests into it, and then bounces, breaks above it, doesn't really retest into it. So pretty aggressive on this leg right here. You can see how it's staying above the 80 EMA pretty much the entire time. If you're constantly pulling back to the 24 EMA, then it's a bit more responsive. But if you're not pulling back into that like ribbon of moving averages, then you're pretty aggressive, right? If they're actually holding on to those breakout trades. Basically, the question you want to ask yourself is, if I am a breakout trader, am I getting what I want? Am I able to actually trade that and make some profit on that breakout? If the answer is no, and even though you're trending up pretty steadily, like it's very obviously an uptrend, but somehow you still can't be a breakout buyer because it just pulls right back and you would lose your trade, then it's probably a responsive market, and the limit traders, the pullback buyers, the more passive buyers are in control, right? You'll see that a lot of times when people see these very trendy days and they're like, how am I losing money? I don't understand how I'm being a buyer and still losing. It's because they're trading in a vertical distribution, right? And they are buying weak breakouts. For example, if you bought a breakout of this high right here, you're probably losing that trade. If you bought a breakout of this high right here, you're probably losing that trade. If you bought a breakout of this high right here, you're probably not losing that trade. So that's where it starts to shift into a more aggressive market. And then obviously the aggressive market doesn't last for very long because then it pulls back and starts chopping out like crazy. But you can see the market shift back and forth, like being aggressive, being responsive. So like right here, it's holding above the ADMA, but then it pulls back to the 24, pulls back to the 24. And then it kind of gets very choppy. So like on my screenshot here, it looks almost identical to what we saw today. 24 EMA keeps being tested or breached with those like traps. And then the breakout buyers are not really getting a whole lot of momentum. And you can see the difference right here. The breakouts have a lot more momentum. You're not testing the 24 EMA. So in this little up move right here, very aggressive, which is why the pullback was so aggressive. So Marcel's question was, only entrance would be the 24 EMA if you missed the breakout. Yep, so you basically don't want to be breakout buyers if it's a responsive day. You can only be breakout buyers when it's an aggressive day. So if you're constantly seeing, basically think about this pattern right here. Imagine that was happening on the entire trend. So the entire trend, you're just breaking prior highs, and you're not really pulling back to the 24 EMA. If you keep seeing that, then you could be a breakout buyer and fairly be safe in your trade. But if you're seeing stuff like this, then being a breakout buyer is a bit dangerous. So for example, at the time, taking this breakout buy was a bit dangerous because you didn't know that it was going to be aggressive, because for the rest of the move, it was not aggressive. So you would have been better off being a passive buyer either on this pullback here or this pullback here. That breakout buy is pretty dangerous. This would be what I consider a bullish responsive day. If we go to the 30-minute from today, it started on this candle right here. So I'll zoom into just today. It started right here. If we look at the 30-minute, it was aggressive the entire day, right? It was staying above the ADMA pretty much the entire time. And we could see that, we could see the confirmation in the candlesticks themselves. Because look at the candle lows. Pretty much every single candle low today, until the close, they were protected. Basically every single candle low up until literally the closing candle, they were protected. Every time you tried to break a candle low, it did not close with any momentum or delta below that candle low. You had one candle close today that closed relatively strong on the candle low, and it was this candle here, the closing candle. And even that candle did not close strong below the ADMA. So it was still aggressively bullish. So it depends on what time frame you're looking at, right? If you're looking at the 1 minute, I'd say it's a bit more of a responsive day, scalp-wise, right? If you're looking more at the 30-minute, it was a pretty aggressive day on the buy side, pretty much the entire time. Now, you could argue that during, like, say, I'd say 11 o'clock to about 1 p.m., this little section right here, you're shifting a bit into a neutral market where the candle highs and the candle lows are being protected. So you're not seeing any significant closes below the prior bar low. You're not seeing any significant closes above the prior bar high until 1 p.m. This candle closes above the prior bar high pretty strong. But then, unfortunately, after that, it goes back into a neutral market, right? So based on the ADMA, it's still aggressive. You're still staying above that ADMA the entire time. But if you're going back a step further, back what we talked about in like the first video, watching like the prior bar lows, the prior bar highs, you're getting a little bit more neutral because the clusters of candles are not really going anywhere. This would be what I consider a weak high. So we broke this prior high, but it didn't really go that far away, and it's already showing sell pressure. So we don't have the confirmation until tomorrow. But if we start seeing more sell pressure trying to push these prior bar lows here, then obviously this would end up being like kind of a sweep, almost like a rollover top, and then we push back down. Going back to what we talked about in the first video yet again, that would be targeting like the point of origin. But we don't have that confirmation just yet. We'd have to wait until tomorrow to see where the next cluster of candles is. Is it holding above the high, or is it holding below the low? My question regarding vertical distributions is, how often is this scenario like today in which a vertical distribution turns into a decent, strong trend? You can't really say. I don't really have the numbers for that. What I'm really looking for is how often recently has the vertical distribution come to an end violently and given us a very strong reversal trade back to, let's say in today's example, it would have been back to like the open. Recently, we haven't been seeing too many vertical distributions give you like insanely strong reversals unless they are from imbalances, which is not going to make a whole lot of sense for you guys in today's video. But if you understand my volume profile techniques, when the vertical distribution is turning into like a P-shape imbalance, recently we have not been seeing follow through with these P-shape imbalances. We have been seeing them come to an end and retarget that lower tail, which funny enough today is a P-shape imbalance. And I was just saying in my closing statement in Discord that we need to be very careful tomorrow because these imbalances have not been holding recently. So we haven't been seeing the vertical distribution come to a violent end that same day. It's more so like the following day or sometime that week. That imbalance has been retested pretty aggressively. So that's really what we're looking for. We're looking to see, based on the relative price action we've been seeing the last couple of days or last week or so, are the vertical distributions being respected where they're holding pretty much the entire day? Or are we seeing these violent reversals and going back into those lower tails? What do I mean by candles being protected? That will make more sense once I talk about order flow. But very, very basics is when we have a candle and the following candle, let's say, breaks into a new high, and then we see that again and again. The lows are being protected. They are not being taken out. It's a very one-directional price movement. It's called one-time framing. But if you keep coming back down to retest prior bar lows, but it's just not breaking them, it just keeps bouncing off of them repeatedly, they are being protected. But if we come back down and we have like a nasty red candle that breaks that prior bar low, possibly breaks multiple prior bar lows, then we would not say they're being protected. They're quite obviously being taken out. So it's when one side of the candle is being repeatedly saved by those pullback traders or the responsive traders, the limit traders, whatever you want to call them. And that is very important when you're looking at market structure, because let's take market structure for example, right? We talked about viewing like clusters of candles and how they're reacting to each other. Are they putting in a high? Are they putting in a low? What are they doing, right? What direction are they moving value in? Which will make more sense in my volume profile video. But not only that, inside those movements, is it very one-directional in the sense of like every single candle low is being protected or every single candle high is being protected? Or is it slightly choppy? Is it a bit more neutral inside those clusters, right? Typically, this is a technique that is not used on a 1-minute chart because the 1-minute chart is very, very sloppy candlestick-wise. I would say minimum 5-minute, but realistically the 30-minute is what you would be using this technique on, because the 30-minute highs and lows are actually respected. They're actual levels that have some value. The 1-minute candle highs and lows, and even sometimes the 5-minute highs and lows, they don't really hold a lot of value. Now, we have seen very strong moves recently, which will happen based on headlines, or if there's like volatility spikes. You will see the 1-minute high and low or the 5-minute high and low be respected more often. Typically around like FOMC or earnings, or like I said, some type of volatility event. But more often than not, in a normal market, you're watching that on a 30-minute. Which is basically the entire idea behind a market profile, which we'll talk about in the volume profile series. But if you guys are still unfamiliar with like how to read a market profile, what are the A's, the B's, the C's, like all these letters, what do they mean? It's literally just a 30-minute chart. Instead of looking at the candles, they have letters. So the first candle of the day, 9:30 to 10 o'clock, is the A session, then the B session, then the C session, so on and so forth, right? But that's the whole idea behind market profile, is watching how the highs and lows are interacting with each other. Are they poor highs, poor lows, weak highs, weak lows, single prints, etc.? I'm getting a bit ahead of myself. That's like 2 videos away from this one. So Zach said, once it breaks the 30-minute low, is it no longer safe to be a buyer because of the possible shift in structure? Yes is the easy way to answer that, where it kind of depends on how much the value is shifting and how big of a break are we talking. In today's case, if we're using this as an example, I wouldn't say this candle by itself is basically telling you, okay, I can no longer be a buyer, because it's not really threatening that much. You still have a massive cluster of support right below that. So there's a lot of variables you have to take into account. How strong of a break is it? How many candles is it taking out? How much is the value shifting? How bad was the high before we started breaking those lows? Was it like a massive sweep on the high and there's a lot of absorption on the high, so now we're going to squeeze out all those late buyers? You have to take into account a lot of things. It's not just as simple as the candle being taken out. But like I said, the easy answer is yes, it is a red flag that, hey, we have been one time framing bullishly this entire way up. We have been protecting our 30-minute lows the entire way up, and now we are not doing that. Now we are breaking these 30-minute lows. So you are seeing something happen that has not happened the entire day. So, of course, that is a red flag. But like I said, then you have to take into account the variables to see how bad of a red flag it actually is. When there is a cluster of candles, should you wait for the break on a pullback or get in at the bottom of the cluster? These are not like signals, as I talked about in the video. I talked about in the first video and the second video. I did not show you guys a lot of like trade examples with these concepts because they are not just blind signals that we say, okay, because it's breaking these clusters, I'm going to be a buyer or I'm going to be a seller. That's not how this works. These are just signals to identify how strong or weak the current structure is, and are we shifting into a new structure or are we following the same structure, right? Now, in one sense of how we can utilize these candle clusters for our trading, as I talked about in the video, I talked about how when you have a cluster of candles, you got a bunch of candles kind of back to back. We have the highs of the candles, the lows of the candles. And let's say we're longing already. We're long from way down here. So we're long from down here, and then we see a cluster of candles start to come in on a high. We don't want to just quickly move our stop loss below that cluster until we've actually taken out that cluster and pushed away from it to confirm that that value is actually being protected a little bit by the buyers. So when we push away from that cluster, then I feel safe to pull my stop loss below that cluster because, like I said, now they're showing you, hey, there's actual value here, and we most likely will be protecting it on the way back down. Like if we were to retest this, the buyers would come in and protect it, which would therefore protect my stop loss. If you move your stop loss during the cluster, so if we're long down here and it pushes up and it starts chopping, and we don't wait for that break, and I pull my stop loss very early, then during that chop, as they are grabbing the lows and grabbing the highs, if I put my stop loss too close, I'm going to get stopped out. I would say, and I think I talked about this in the video, if you are ready to get out of the trade and you already have taken profit and you're like, okay, I've already made a decent amount of money on this trade, I'm ready to get out, I don't really care if it stops me out, you can do that. You can be a bit more aggressive and you can pull your stop up without waiting for that break. But you need to understand that you are giving yourself a high probability of being stopped out. Now, if you don't want to be stopped out and you're trying to protect that trailing stop as much as you can, you need to wait for that breakaway from that cluster to confirm that that is actually value, that it's actually being supported. Their question was, but also breaking the 30-minute lows or highs could be a good opportunity for a sweep trade. Yes. So just by itself, the break of a cluster of candles is not a signal. It does tell you to pay attention and look for a signal, whether that could be a rollover top or bottom, a sweep on the high, a sweep on the low, whatever it may be. It is a wake-up signal to tell you, hey, look for my playbook. Look for your playbook of trades. Is there a trade happening in this general area? Or if you're in a trade already, as I just talked about, can I move my stop to this area? So it is kind of waking you up, but in itself, it is not a trade. There has to be a playbook set up there for it to be a trade. You guys will see this a lot in my next video on indicators. I talk a lot about all these different things that are happening with the indicators that are like waking you up or they're providing more value to you, but they're not like signals. It's not just like a blind, I'm going to press the buy or sell button. And I get those questions all the time on my live stream and on my videos where people are like, okay, you just taught me all that information, but where is the buy signal or where is the sell signal? They're missing the entire point, right? They're missing the entire point of doing this analysis. A great example, and as you guys are going to see in my next video, I talk about this a lot with like the pivots on the OTS and the shading on the Momo. So like the purple shading, the gold shading. Just because there is purple shading, that does not mean that I am just hovering over the buy button and pressing the buy button and saying, oh, it's purple, I'm buying. It is just adding value and telling me there is a higher probability for a buy trade in this area. So I want to look for my playbook patterns to see if there actually is a buy in this area. It is providing a bonus to that strike rate. Maybe the normal strike rate without the purple shading is, say, 40%. But with the purple shading, it's probably 50% or 55%, right? It's all about Confluence. It's all about taking all of these things that I'm teaching and putting them together and saying, okay, if I can find a playbook trade in this area and X, Y, Z are also happening, that is making my trade better. I have a higher probability for this trade. It's not turning every single one of these little things that I teach into trades. They are just providing value to your trades, to your playbook trades. For example, throughout the day, I could be watching, I mean, you guys have seen my live stream. I could be watching like 20 different things, right? We're looking at the delta, we're looking at the 1 minute, we're looking at the EMAs, the big trades, the DOMs, the volume profile, the market profile, the VWAPs. I mean, you name it. The OTS, the Momo. I mean, literally, you name anything I watch on stream. I'm watching all that stuff, right? That does not mean that I have 30 or 40 different trades that I like to take. I'm still only taking like 3 or 4 different types of trades. We have the sweeps, we have the rollovers, we have the like overnight fades, right? We have the VWAP trades where they're like the bull flags or bear flags in a VWAP. They all kind of break down into 3 or 4 different types of trades. So I'm looking at like 40, 50 different things for all this technical analysis. I'm doing all these fancy, different fancy things with my charts, like looking for the market structure, looking for the prior bar lows and highs, the clusters of candles, the point of origins, etc. But they are all just providing value. It's all like one big funnel. They're all just funneling down into my playbook. And I still have to see those playbook trades firing, or none of that other stuff matters at all. Okay, so Sam, you're asking about the difference between the types of market shifts. So when a market is going from, like, say, a bullish aggressive market and then slowly starting to come back down into like a more neutral or maybe a responsive market, or in the case it could shift from a bullish aggressive market into a bearish aggressive market, kind of like an A-shaped top where it goes straight up and then straight back down. Your question is like, what is the difference and how do you trade those? So the main thing to look for when the market structure is shifting is what type of trade is happening, I guess you would say. So, for example, if the market is, let's say, an aggressive bullish market, and then we see a little bit of chop, so it's getting a bit more responsive, it's getting a bit more neutral, and then we see a very quick rollover top. So we put in a high, it pushes up, puts in another high, comes back down, puts in another high, which is a lower high, and then it comes back down. If you're going from a very aggressive market quickly into a rollover top, that would have a higher strike rate than if you were in a responsive market, like a vertical distribution, and then you saw a rollover top. So basically what I'm saying is some type of trades work better depending on what type of market it is. Like the sweeps. The sweeps also work better in an aggressive market because they are pretty aggressive. They like to trap those late buyers and very quickly squeeze them out. If a sweep is very slow, it probably has a lower strike rate. The only exception is if the sweep is very slow, but it has a lot of absorption, because absorption is typically very slow. Now that will make more sense later in the Delta series, the Delta video, I should say. But yeah, there's variables to it. It depends on what type of trade you're seeing. You have to identify what type of market your trade does better in. A great example, and I always come back to this because it's a Widowmaker pattern. People really struggle with this pattern, is the vertical distribution. Many of my trade techniques, like my sweeps, my rollover tops, I mean, pretty much any of my topping signals that are leading to top reversals back down, their strike rate gets like cut in half, possibly even more during a vertical distribution. All of those patterns perform much better during an aggressive market. So you kind of have to identify based on journaling or whatever, however you want to do it, you have to identify what type of market your trades do well in and try to stick to that market. For example, people should understand, do their trades they like to take, do they do well in normal volatility, low volatility, high volatility, that sort of thing, right? People will have these like fantastically consistent trades. They keep doing them again and again and again. They're doing great, right? And then the market shifts a little bit, like we did recently in the last couple of weeks, and it gets much more volatile, and the liquidity falls off a cliff. And then their trades don't work anymore. They're like, wow, what is happening? Did I forget how to trade? It's like, no, you didn't forget how to trade. Your patterns just are not high volatility patterns. Your patterns do much better in sticky markets where the market is creating these large clusters of candles and they're not really pushing aggressively in one direction, or they don't have these very wide clusters of candles where they're like sweeping both sides of the candles a lot, right? So you need to understand what type of market your trades do well in. Bullish aggressive, bullish responsive, bearish aggressive, bearish responsive, neutral, etc. Low volatility, high volatility. Would I say that these patterns work better on high volatility? I wouldn't say high volatility. I would say they work best on like low to normal, maybe slightly above normal. Not very high. They're okay. There's a difference between like high volatility and aggressive, right? You can be in an aggressive market but still have very good liquidity. If your liquidity is very high and it's keeping up with the price action, your volatility does not have to be very high to be aggressive. What makes the volatility very high is when you're in an aggressive market, but your liquidity is very low. Once again, this will make more sense when we get to the end of the series when we talk about order flow. I'm going to talk a lot about liquidity and volatility in that video. But yeah, don't think that aggressive always means high volatility. They're not exactly the same. At least the way that I use them. Think about aggressive as more one-directional. It's not exactly high volatility or low volatility, it's just one-directional. One side of the market is very obviously in control, and they are not allowing the other side of the market to really get involved. One thing I wanted to make sure that you guys understood was we talked about the like optimal entry stuff for like the sweeps and the rollover tops and the rollover bottoms. Do you guys understand like what I was talking about with how to find where your like optimal entry zone is and why certain areas no longer are optimal because your risk reward is getting too low? So let's come up with like a random trade here. I'm not saying this is like an actual good trade. I'm just going to make up an example here just so I can kind of explain the process. Let's pretend like this is the open of the day. And we shot up and we kind of went into like a vertical distribution, right? And let's pretend like we wanted to short this back into VWAP and back into the open of the day, because we had all these different signals firing and telling us that a short was the highest probability trade that we could take. Like I said, this is not an actual trade example. I'm just using this as an example to find your optimal entry and your where it's not optimal anymore, right? So let's say that we were basing this off of like this weak high right here. So it started to re-lose this high that had kind of a trap. It had that cupping pattern, right? And we wanted to take this as a short on like this candle right here. And our first target was going to be VWAP, and our second target was going to be this point of origin. So we'll mark out that point of origin, and we'll say that would have been our second target. So based on that, based on what our entry idea is, based on where our targets are, we're like, okay, what is this offering me? If I got in here, this is offering me, let's be exact here, it's going to be from 82 to like, let's just say 78. So it's going to be about 4 points to my first target, and it's going to be about 12 points to my second target. So for your first target, if you want to keep about a 1-to-1 risk to reward, let's go ahead and pull up the short here. If we want to keep a 1.25 risk to reward, sorry, I'm not sure what I just said, but it's 1.25. I think I said 1-to-1. A 1.25 risk to reward, our stop loss would have to be 2.75 points above that sweep level. Now, like I said, this is not an actual trade, I'm just using it as an example. So if you are used to taking shorts that are around that stop loss, like if you think that's a comfortable stop loss above the high, which is about, let's say, 3 to 4 points above the high, if you think the probability of that being hit is much lower than the probability of you getting to that VWAP target, then that's not a bad place to enter, right? But if I start lowering this, and I say, okay, if I get in down here, I would have to keep bringing my stop loss down to make that make sense, right? So now look at this trade. Now my stop loss is below the high, which is never a good thing, right? If you're shorting a high like this based on a sweep or a rollover or whatever it may be, you almost always want your stop loss to be above the high with enough room that you're not going to get search and destroyed, right? You're not going to get hunted. So for this to make sense, I would have to pull my stop loss down below that high. So in order for this to even make a semblance of sense, like even the smallest idea of a good trade, I would have to be going for a very large target back into that point of origin. So basically, I would have to give up on that VWAP target. That VWAP target is not enough. And I talk about this in the video. I talk about how you can always make this make sense by pulling down your target and pulling down your stop loss and just saying, okay, I'll move my stop loss closer. I'll just go for more on my target. You can always talk yourself into this being a good trade. And that's why you need your trades to be extremely mechanical, so you can't have that bias and you can't just keep moving your trade around and saying, oh, this makes sense. So what I mean by mechanical is, like I just said earlier, almost always on all of these trades, we know that the likelihood that it breaks that high is pretty high. Like, it can break that high by a little bit. So if our stop loss is below that high, we are most often going to be stopped out. So my mechanical stop loss needs to be above that high with enough room, and this is relative, right? I can't give you guys an exact number. It has to be based on the current volatility, what's going on in that current price action. But based on our current volatility, how much are these highs being hunted? If they've been hunted most of the time by about 4 points or so, then I would want my stop loss to be more than 4 points above that high. Okay? So that would be a mechanical stop loss for this entry. It needs to be above the high with enough room that protects me from being hunted. Now, obviously, you're still going to get hunted every now and then. Trading's not perfect. But just based on taking this trade 10 times, 20 times, 100 times, whatever, you'll start finding that sweet spot on where your stop loss should be. Once you figure out where your stop loss should be, you need that stop loss to be relatively where you think it should be. You should not be putting it farther out than that. You should not be putting it closer than that. You need your stop loss to be mechanical in where you put it, and stop messing with it. Now, obviously, I am not talking about managing the trade and moving the stop loss after the fact once you're already in profit and you've taken profit and all that stuff. That's not what I'm talking about. I'm talking about where your initial stop loss goes. It needs to be extremely mechanical. You need to know relatively where that stop loss goes in that setup. For a rollover top, it needs to be above the high. For a sweep, if it's a bearish sweep, it needs to be above the high of the candle, right? So you need to understand where the mechanical stop loss is. Put it relatively where that is. Same thing for your target. Your targets are obviously going to move around. It's not always going to be the same level. If you're targeting prior lows or prior value lows, whatever it may be, those are not going to be the same every day. It's not going to be a 10-point value area every single day. So that is going to be mechanical, but it's also going to be a bit fluid, where it's not going to be 10 points every time or 5 points every time. But every time you will be targeting the same value level, right? You'll still be targeting the value low. It just might not be the same amount of points. Okay. We call that trading your P&L, where you're constantly locked in on, I want to risk 5 points and I want to target 10 points. The market is not going to perfectly fit your P&L trade into it every single day. You need to fit your trade into what the market is telling you. Okay. If you normally risk 3 points above the high, but our volatility is extremely high and it's breaking the highs by like 5 points on average, then your 3 points above the high is basically nothing. You're just asking to lose money. But because you always risk 3 points, you have to do it. But then you lose the trade and you complain about it, right? So don't be locked in on trading your P&L. You need to figure out where the mechanical stop loss should be. What are you targeting mechanically? Is it VWAP? Is it a prior value level? Is it the point of origin? Whatever. Target that same thing every time. And then obviously, I can't get into this in this video. We'll talk about it more in like the order flow video. I'm not talking about managing your trades. Like obviously things change, you take profit, you move your stop losses, yada, yada, yada. We'll talk about that in the order flow series. But in the beginning, when you're setting your trade up, you want to be very mechanical. So understand where your stop loss should go, understand where your normal targets are, and then find out where your risk to reward no longer makes sense if you leave your stop loss where it should be. So moving the stop loss below the high would just ruin the trade regardless of the take profit. So not exactly. Like I said, we'll get into this more into like the order flow video. But let's say, for example, if we shorted this, our stop loss is up here. We're targeting like the point of origin. We're targeting like, let's say there's a level right there. If we hit this level and we're like, okay, that's good, I'm going to take profit. I'm okay to move my stop loss now because I've already taken profit on this trade. I'm like massively up on this trade. Your stop loss doesn't need to be, and it shouldn't be, still negative. Where, okay, I've said that I like this enough to take profit. Why would I now allow it to go all the way back to my stop loss and lose money? You don't want to be moving your stop loss right away. There needs to be something happening. Are you taking profit? Is there a market structure shift? Is there another signal coming in that's kind of going against or invalidating your initial signal? So when I'm saying your stop loss needs to be above the high, I'm talking about the initial stop loss when you take that trade and you determine where you should be entering that trade. Yeah, the patterns that I teach are basically the same exact thing on any time frame. They're just candlestick patterns. Candlestick patterns don't really care too much about time frames. You'll see the same patterns across the board. Now, with exception, right? There are some exceptions. Like, for example, an exception would be we don't really look for rollover tops on, like, the daily on ES. Because ES daily is almost in a permanent vertical distribution. We have basically been in one long vertical distribution since, like, April, since May or April. So there are exceptions, right? Some patterns are obviously scalping patterns, some patterns are like day trading patterns. But for the most part, they're just candlestick patterns. You can see them on pretty much any time frame. It's whether or not you want to trade them on any time frame. How much does the strike rate change based on that time frame, right? But all right, guys, I think we covered pretty much everything. Unless you guys have any more questions, that's about all that I wanted to cover today. Let me see here. Oh, one thing I wanted to cover was the incomplete auctions. Do you guys understand the incomplete auctions? I know I didn't cover it too much in that video because it's more of a volume profile technique. It was kind of a teaser. I was just teasing you guys for like the volume profile stuff. This doesn't make a whole lot of sense until you understand the volume profile concepts. But basically, what you are looking for, funny enough, we're actually seeing one happen right now. So if we look at Friday, October 10th, and we had that sell-off, right? And we have this massive value area on Friday, October 10th. And we started losing it, and then we started retracing into it. But then look at this failure right here. We start to come back down in value. So that remaining gap, the gap of the high of that day that retraced and where it was supposed to go, it was supposed to finish that value retrace back into that value high. So whatever was left open is an incomplete auction. And it's basically telling you, hey, pay attention. There might be a market structure shift happening in this area because it was supposed to finish that value retrace, but it did not. So in this case, the value retrace was bullish. The buyers were in control, retracing to the upside. They did not finish that retrace. So what does that mean? The buyers were not able to continue going up. So therefore, the sellers took control. Where did they take control? Wherever that incomplete auction starts, right? The incomplete auction is this zone right here. So the sellers took control right here. So there is a market structure shift happening where that incomplete auction has formed. And we saw that going into Thursday and Friday. You had that sell-off on Thursday and the sell-off on Friday. Now, obviously, it started bouncing, but you had a really strong sell-off of about 200 points from that incomplete auction. So it warned you, hey, there might be a market structure shift happening right here, and there in fact was. And now, because we bottomed out, we are going to finish that incomplete auction. They are going to repair it. It acts like a gap. It acts like a single print LVN or a gap. They're all kind of the same theory. They are areas that act like magnets and they want to be filled in. So when they formed, they caused a little bit of a shift in structure, but after they have formed, they act as a magnet. They kind of pull price back into them. Like I said, same theory with LVNs, gaps, single prints, incomplete auctions. All right, I appreciate you guys watching. This has been the Q&A for the Becoming an Apex Trader, the DBT method market structure video. If you guys have not seen that video, go check it out. Be sure to check the playlist. I will put all these videos into a playlist. There's going to be 5 videos on becoming an Apex trader and 5 Q&As that go with every single video. So be sure to check them out when they're all released. We have 3 more videos coming up. We have one on indicators, one on volume profile, and one on order flow. If you guys enjoy this content, hit that like button. Be sure to subscribe, and I'll see you guys in the next one. Peace, everybody.